Before talking about the future of mutual funds, let's understand what a mutual fund actually is. A mutual fund is a pool of different investments made by investors like you and me, which is then managed by a professional who is called a fund manager. And it is this fund manager's responsibility to invest that amount into different securities such as equity, bonds, etc. Basically, mutual funds provide you the most simple and easy way to get the benefit of the expertise of that fund manager. Not just that, you will get a part of the entire diversified portfolio that is being managed by this fund manager. Just like getting a slice of a pizza. But with all the future advancements that are happening right now, mutual fund industries seem to be changing for good. Let me give you an example. Because of all the robo-advisors and the online platforms that are coming in for mutual fund investments, the efficiency of the mutual fund houses is improving, and that means the costs are reducing for investors like you and me. Additionally, newer mutual funds are coming out in the market that suits the ideologies and the themes that go with newer investors. But now, let us take a look at the advantages that mutual funds provide you. Let's start with the first advantage. And this is the advantage of diversification. Mutual funds typically don't invest in a single asset or security. They tend to diversify their portfolio by investing into different asset classes like commodities, debt securities, or equity. You don't carry any particular risk from investing in just one particular type of an asset class. Number 2 is professional management. Like we mentioned in the start, a mutual fund is managed by a professional and an experienced fund manager. And this fund manager uses all his experience to generate an alpha or a return that is above the benchmark. And that is exactly what you're paying for. And that is something me or you, people who do not really understand the markets, can still get. Number 3 is liquidity. Mutual funds can be bought or sold, particularly at any given time whenever the markets are open. That means you do not have restrictions in buying additional units of mutual fund, nor do you have any restrictions redeeming or selling those units of mutual funds. And this is termed as liquidity. And number 4, it's easily accessible. Investing in mutual funds is accessible using a whole host of different options. You could go the offline method and fill a form to invest in a mutual fund, or you could access mutual funds through online platforms where you can just use a simple website or an app to invest in those funds. However, it's still not over. There are some red flags that are associated with mutual funds. The first red flag to keep in mind are the fees and charges that are charged by the mutual funds. Although most of the charges come under the total expense ratio charged by the fund, there are some other fees or charges that might be present in the fund, such as exit load. And that is why it is very important for investors to know what are the exact charges that are charged by a particular mutual fund. Number 2 is that a mutual fund does not guarantee any returns. If you invest in a fixed instrument such as a fixed deposit, then the return is guaranteed to you throughout your tenure. However, if you invest in a mutual fund, there is no guarantee of returns, and the mutual fund value can go up and down as well, as the mutual fund is aligned with the market conditions. Which brings me to point number 3, market risk. If you invest in a mutual fund, well, you have to carry the market risk as well. Which means if there are economic downturns or if the market is not right and it's undergoing a recession, it will affect your fund performance too. And finally, the last risk that you will have to look out for is no control or lack of control. By investing in a mutual fund, you give away your investments to a professional fund manager. And it is this fund manager's duty to allocate the resources well into different asset classes. However, because of this, you will not get a choice to invest the money directly into a particular security or an asset class. And so, if you want to invest your money into a particular asset class or a particular security, then you will not be able to do so in a mutual fund. Now, let us quickly summarize what we learned in this video. Number 1, we learned what is a mutual fund and understood how future technology could affect mutual fund. Then we took a look at the advantages of investing in mutual funds. And finally, we took a look at 4 red flags that you should know about as a mutual fund investor. Now, with this, you are ready to go and create your own mutual fund portfolio by yourself. However, time in the market is supremely important. And that is why, if you're deciding on creating a mutual fund portfolio, please remember, invest for a longer period of time to really generate those returns you're looking for. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.